calling a spade, I've made more of my money through capital growth, commercial property than almost any other aspect, because there's genuine upside in this. Like, I bought a shopping centre in Brisbane a couple of years for about it was 9.8, had it recently valued at 13 mil, like this big capital gains in a short period as a percentage. Similar result, I bought in Perth for about 12, it's up towards 15. And some of the cheaper assets I bought, one for 4.8, it's now at 7. Like they're all going that direction. Yeah. And these figures are enough to kind of have big chunks of equity to then go again if you choose to.
Welcome to Checks and Balances, brought to you by Partners Life. I'm Michael Vincent. This is James Blair. And today we've got Scott O'Neill, CEO and founder of Rethink Group Australia, here to talk about commercial property investment versus residential. We're back in your life, Scott. Welcome back to the podcast again.
Good to be here, boys.
So if you haven't seen the other episode we've done with Scott, where he talked all about his journey, how he was originally a residential property investor, switched to building a $100 million commercial property portfolio, then created the largest commercial property buyers agency in the country. Make sure to go check out that episode. We'll put it in the show notes. Today, though, gents, is about commercial property versus residential property, talking about the key differences between the two, because resi's so easy to understand, right? Everyone needs somewhere to live, right, Scott?
Yeah, and look, this is the starting point. This is the big kind of, all right, now I understand resi. Where do I start with commercial? Like, it's pretty hard. It's easier than it was before, but it's pretty hard to get like straight answers on this, because everyone's got either a big opinion, vested interest in residential, or you go to a commercial agent and they're talking so high level, it's hard to kind of bridge the gap. But, being through it, living through both investment classes myself, I find it very easy to summarize this topic.
Yeah, I often find that when we're talking to people about the two, everyone in a lot of people in the residential camp back residential because they just simply don't know the information about commercial, and they don't want to go, well, I actually don't know anything about it, so I'm that's why I'm doing resi.
Yeah, and like when I was looking for my first property, like it took me 12 months to get my head around it. Too long, and all the information was from different countries, and yeah, like coming into New Zealand right now, it's like going back in time 10 years in Australia. There's zero information out there. Like, you can Google generic stuff or chat GDP stuff, but it's really not, it's not the reality of what you'll find on the ground.
Yeah. Yeah. And so, I mean, just to be clear, we're not saying everybody should run out and go buy commercial property tomorrow, right? Like, you're not going to start by buying a $2 million commercial property, because if that property's vacant, you're probably in a lot of trouble. Residential is a great place to grow your portfolio. We'll talk on the lending side, smaller deposit. But as you're starting to think cash flow or diversification, or what are my goals? How are they matching? Looking at different options. Probably one of the big ones to start with, Scott, which maybe is a little bit of a misconception. How much residential is pretty straightforward, right? You buy something, a 2-bedroom townhouse for $700,000. If it's a new build, we only need a 20% deposit. We need $140,000 of equity. A lot of the time people go, you need so much money to get started with commercial, I'm not even going to bother looking at it.
Yeah, and look, it is a true barrier to entry. Like you're not going to get in there. You won't get much change out of, say, $400,000 as a starting point. $400,000 cash or equity. So there's like a big opportunity for those residential investors that've got an established portfolio. You can probably go buy assuming you can get access to that equity, you can go buy a commercial property, and the bank will do the rest. You'll leverage that for $350,000, $400,000 up to circa $1 million for a purchase. And there's a fair few deals out there for $1 million. But that's kind of entry level. And commercial, the more you spend, the better it gets as well. Like, it's kind of like unlimited. You can spend $1 billion on a commercial. You buy a Westfield or something. One step at a time, okay? Yeah. But yeah, it is harder. Like residentials, there's a lot more stock at cheaper price points. Everyone understands it. And that's why everyone defaults to that. So I'm a big believer, start with residential, like to learn, get the experience, understand how to deal with maintenance and vacancies, and, a market that's going up, a market that's flat, market's going down. Like, it's all, you got to learn this stuff. And then once you've got your head around that, commercial's where you finish, because that's where you'll truly retire from.
Yeah. And so the $400,000, so that's a good kind of myth busted there in terms of the amount of cash. Mike, another big piece is around the lending side, right? So we talk to those in the resi space and they get 1, 2, 3, maybe 4 properties. And then we start to get quite tight on the lending side. There's views around commercial property that the interest rates are really high, the amount of equity I need, how quickly I need to pay off the loan. I don't even know how my income applies to it. How does lending work I think we've done lots of stuff talking about how lending works on the resi side for investment property. We'll put a link to an episode that explains that, so go check that out in the notes. Commercial property lending, how do I get some money?
Yeah, cool. I mean, it's essentially, we're still looking at the same fundamentals, right? So what are you buying? What is the income generated from it? The difference with commercial property in terms of the assessment is usually commercial property is a lot more cash flow positive, which is, it is substantially different to buying a negatively geared residential property because you are having to prop that up with your own income. So you get tapped out on residential properties quite a bit quicker. Now, the main differences in the loan are the loan term. For a resi property, you're looking at a 30-year loan term, 25 if your bank's been a bit stingy on the day. For a commercial property loan or a term loan, you're looking at a 15-year amort term. So you're paying the loan down over 15 years and you'll get a 5-year loan term. What that means is you have to renew the loan every 5 years to make sure that it's renewed and it kind of kicks out again, right? But to be honest, it's not really too much hassle. And banks are pretty used to it. If the property's still performing well, it's still got a tenant in it. There's no issues. There's no reason they wouldn't just roll it over.
And how does it work with my income? Because I think, talking to you about it a little bit last night in our webinar, that was one piece I found really interesting. The fact that they potentially assess the deal on the deal, opposed to going, that you buy this residential property, you're going to have to top it up $2,000 a month. I got to stress test you at certain rates.
Yeah.
Will you, are we looking at it in isolation, or how much does my income play into it?
Yeah. I mean, you can on a commercial property, you can have a loan where the focus is just on that debt and that property, right? So, obviously they will be looking at things in the background. If you're underwater and you're a huge risk, or you've been bankrupt over here, they're going to be asking some questions. But if you're a high quality applicant and you've got, the income from the commercial property has, a 1.55, 2 times interest cost cover ratio and a debt cost cover ratio, which is pretty good as well, you're highly likely that they will be able to just assess the loan on those terms.
Yeah. And that was a big thing for you, Scott, in terms of your journey from resi to commercial, right? Was that lending aspect and going, how can I get the numbers to work? How can I continue to grow my portfolio?
That's right. I had access to a good amount of equity, like from a recent renovation job. The residential broker was just saying, nope, you're done, serviceability limits, because they put all the factors of safety and shave off the income and then look at half your weight. Like, it just really got tough. And commercial, it was a different department, and obviously a different type of property I was purchasing as well. So like you said, the income is massively higher. So the easiest way to boost serviceability is have more money coming in. Serviceability is number one, coming from your rents and obviously yourself and your job. So I couldn't affect the job anymore. But getting a higher income property, it just opened it up and kept going from there. And it literally changed my life. I would have bought probably a quarter of what I did if I stuck at
doing the
resi only.
Yeah. The other thing that you talked about there was the interest rate. So, the big, bad, scary commercial interest rates. Look, to be honest, as a rough guide, we just say, look at the bank's resi floating rate, and that'll be pretty close to their investor rate for a commercial property. Some properties may have a higher interest rate because of the risk factor on them, but for a pure investor, it's unlikely that you're actually going to get there because that stock is significantly riskier. So for that sort of thing, I'm talking about, a specialist property in some far-flung corner of the country, like a gas station or something like that, down in, I don't know, the far corner of the South Island. That's a pretty risky investment because if that tenant goes, you have to get another specialist tenants in there to use the property. So for that, you're looking at a much higher interest rate.
Mate, Invercargill needs petrol as well, okay?
I was going to say Invercargill, but I was like, don't say Invercargill. We bash on Invercargill.
Yeah, people in the regions don't get petrol. I don't know. I'm not quite sure how that works.
But like if you look at that from a bank's risk perspective, let's look at a small town in the corner of the South Island that almost the entire town relies on one factory or one industry. Their bank will look at that and go, yikes, man. Like if that goes out of business, we're going to have some issues here.
Yeah.
The flow-on effect into the community and the surrounding businesses.
Yeah, the example coming back to Invercargill, it's a smelter, right?
Yeah.
And they hire about 5,000 out of the 50,000 population. And you go, well, if that left, that would be a lot of damage. But then it's all the suppliers to the smelter. And you go, there's probably about 20,000 people wrapped up to this one operation and what happened. And I think the example you gave in the webinar last night, Scott, was good, was your yield can be too good. And if your yield is too good, there's no free lunches. What's the catch?
Exactly. And what's the catch is the key word. So if you see a 15% yielding property, the rent's either pumped too high above market rate, the building's either on its last legs, one horse town that's been bypassed by the new highway. Yeah. So, 15% is only as good as the tenant's ability to pay that long term. So, I don't really get attracted to those ones. The best deals, and this will change over time, generally range somewhere between 6% and 7%, give or take a percent either side. They're the ones that will have the best rental growth. And remember, rental growth, think about it from a common sense point of view. Like, you're here to make money off rent. It's not about year one's rent. It's about the accumulation of the total rent over, say, a 10-year period. So if you collect, 70 grand per year, that's 700 grand in 10 years, but like you're going to get growth. So it might be 900 grand if you're getting strong rental growth. But if you buy one that's got much higher yielding and then the tenant gets, falls out every 2 years and then there's no rent growth, like the higher yielding will actually get you less rent over time. Yeah. So it's about the rent growth, the accumulation of it. But more importantly to that even is the growth as well, because those 6 to 7%ers tend to be in great areas with high demand, and the capital growth can be significantly different.
Well, let's get into that, because so you answered the question around yield. So like, once again, comparing residential to commercial, right? Most stuff you go somewhere between like 3 and 5% is probably what we see. You're pretty happy at 5. Yep. You go in commercial 6 to 7. So tick for commercial. The capital gains one is when I hear all the time going like, yeah, mate, you might get some decent yields, but from a capital growth perspective, who knows what the hell is going on? What is happening in terms of capital growth on, say, resi properties doing maybe like 6 and a half, something like that. Yep. What is, I know it's a wide spectrum in terms of what's out there, but what are we doing capital growth wise?
So, this is a big one, and I'll give you a quick backstory here. So in Australia, the same thing happened. And we noticed that all the data out there is done by the Knight Franks, the Savills, the JLLs of the world. And that's for prime, 5,000 square meter plus sheds, 5-year whales, institutional grade assets. So that's where the data is. And we're all reading that. There's none for under the, in the sub 20 mil range, which is what the everyday person would be buying, the $1, $2 million stock.
Yeah, the real market.
The real market. So what we did is we commissioned a study a couple of years ago in Australia where it was examining the medium sales rate for the average type property and comparing from hundreds and thousands of data points exactly how much those square meter rates for buildings were selling in 1995 versus 2023. And the figures were amazing. The compound growth rate was roughly about 6% across the board. This is for office. They all had slight different areas. Yeah. We did it for every capital city. But basically it showed there was growth, consistent growth on every asset class. And, other asset classes are growing faster than others, like industrial is growing a lot quicker than office right now. But long term, that was similar. But that was almost the same as residential. Maybe residential was about 0.75% better. So we did the same study in New Zealand. So again, it was just going through all the core logic data, like just manual data. And I spent a bit of time talking to the head of Ray White, their chief economist for commercial. They do the same thing. Yeah. So it's manual data. There's no easy fix here, and they're finding the same results. So, peer reviewed type stuff. And basically the average capital growth, we could only go back to 2005 in New Zealand because the data basically just goes black after that. There's nothing out there. And basically it's about 5 to 6% and other markets are growing quicker than others, but it's a very similar figure over those exact time periods as New Zealand residential. So the myth that commercial grows slower is a myth.
Yeah. And that's something we hear all the time, right? It's like people can't wrap their head around that. They think there's got to be the trade-off, right? That you can get me cash flow, but I'm not going to get any capital gains over the long term. And that is something that, as we've been going through this process, I was, pleasantly surprised to find out as a complete and utter myth.
Yeah. You're there for growth. And that's probably our most, calling a spade. I've made more of my money through capital growth, commercial property than almost any other aspect, because there's genuine upside in this. I bought a shopping center in Brisbane a couple of years for about it was 9.8, had it recently valued at 13 mil, there's big capital gains in a short period as a percentage. Similar result, I bought in Perth for about 12, it's up towards 15. And some of the cheaper assets I bought, one for 4.8, it's now at 7. They're all going that direction. Yeah. And these figures are enough to kind of have big chunks of equity to then go again if you choose to.
Before we move on, we talk all the time about planning and growing our wealth, but protecting that wealth is just as important. That's why having the right insurance in place can help when life goes unexpectedly.
And that's why this episode is brought to you by Partners Life, a New Zealand operated award-winning insurance provider with over 300,000 Kiwis insured and 89% of claims paid.
Partners Life understand that having some insurance is better than having no insurance. They have flexible and personalized solutions for any budget or situation.
Check out their website in our show notes below.
What about in terms of get the crystal ball out in terms of the forecast going forward? Resi's pretty straightforward, right? You look at the immigration numbers, you look at how many houses we're building, you can kind of get an idea of where things are heading over time. In the commercial space, I'd go, I don't know what I don't know. So I look at the office space and I go, the work from home trend. I look at the retail space and I go, one is, sometimes you go around those shopping centers and you see the for lease signs and go, I don't want that. I don't want that to be me. There's the move to having, obviously a lot of people doing their shopping online, the pharmacies out there, all the mum and pop shops. And then you go, there's the big chemist warehouses rolling in. These trends that change over time. If you're thinking about commercial property, how do you make those decisions when obviously the world just changes faster and faster?
Yeah, and it's a great point. And there's a few points to this. Well, number one, humans are negative bias, probably 80% negative bias. So you'll notice a for lease sign more than you'll notice the shop that never went vacant. So, think about I always bring up the example of my local dentist that I went to as a kid. It's still there, 20, 25 years later. And then same with the doctors, same with the, McDonald's and the fast foods and the, warehouses. There's a surfboard manufacturer down at Kirrawee that's been there for 50 years. So you can buy the right tenant that will outlast you potentially. Sure, there's the examples where you're buying the wrong property. And this is the trick with commercial. The risk is higher. If you buy the dud, you'll get punished. If you buy the good one, you could have uninterrupted income for the rest of your life. So you got to kind of research your way into that side of things and beat the trend. And it's almost like, investing in the stock market. There's blue chip assets and then there's the speckies. So you just got to get away from those ones because they're going to go up and down very quick. And stick to quality, I'd say. And that's how you'd sort of avoid having those for lease signs for good. But, they will come up. And something else that you'll notice is for lease signs don't get taken down because they use them as a lead filter. So some of the parts of Australia, they've got 70% of the ads are redundant. They just keep them up because just in case the tenant inquires, I got this other property. It's a lead source. Yeah. So why would you take it down? They've paid for the listing. And there's obviously multiple listings too. If you go to a local industrial park, you could see 4 different brands advertising, 2 properties. Yeah. So it does come up.
Yep. Yeah. Well, let's talk about the vacancy side because that's probably another thing of commercial versus resi, right? Yep. I'm going to find somebody to rent out the house, right? Maybe go drop the rent. Maybe the market's a little bit more competitive, whatever it might be. The risk that I might not have a tenant for a long period of time on a big asset, potentially tied to quite a bit of debt that I might be principal and interest on over a 15-year loan term scares me.
Yeah.
Surely resi's got the win in that one, Scott.
Yeah, look, it would. So residential, you have more vacancies and shorter ones. Commercial, longer vacancies, but then you've got longer tenure. So over the years, we've sort of looked at all our clients, and the average tenure is about 9 years. And that's kind of like a 3-year lease being renewed twice, 3 by 3 by 3, 9 years total. So some tenants are much longer, and then you get unlucky sometimes, and then tenants fail. So you need to be prepared. And this is where I say start with residential, because you don't want to be caught with no cash buffers and then bang, you get that 6-month vacancy. But then that might be the only vacancy you get that decade.
Yeah.
It's just all at once. I've been in this position. I've had a few clients in this position too. When you're in the middle of a vacancy, you feel it's a dark time, because it's like, oh, there's no leads coming in, like, because you can't force it. Like there's a tenant there or not, and then only time fixes it. You just can't create it that day. And so you do feel a little bit helpless, especially if you don't have a buffer in place. But the idea is buy a property with a tenant in it. I don't like buying vacant. I like buying, properties with tenants in it. And then you basically can say, oh, look, they've been there 5 years. I've spoken to them. They said they're happy. They've spent 200 grand on a fit out. Their business is good. They might outgrow it. You got to go through these things and go, oh, if they outgrow it, what's the process? The process is they'll notify it. Like, let's say you guys have outgrown this place. You're probably going to tell your landlord, it might be mid-lease, because you can sublease and say, look, we found another place. Do you mind if we break the lease? And they'll say no, because you're responsible, but you can sublease it. So the responsibility goes on to you to pay for advertising. And then as soon as you find another tenant, you can just move out of here, and then you can break your lease early, but there's uninterrupted income for the owner. So that's how most vacancies are alleviated.
Yeah. So the net outcome in terms of vacancy over a decade might be the same, commercial versus resi.
Yeah.
But it's like a personal emergency fund. You're using that 30 grand emergency fund once every 10 years, opposed to using $1,000 every year.
So let's say you've got 4 weeks vacancy every year on average for residential. You may not get that. The tenant might stay, but over 10 years, that 4 weeks adds up to 40 weeks. With commercial, you might get 40 weeks in one go, but then the tenant stays. So in a way, they do actually average out a lot closer than you think.
Yeah.
This is over like a large cross section of properties too. But yeah, look, if you buy a thing with a long lease, then you can kind of almost engineer the problem away, because the tenant is responsible. It's an IOU for rent. It's not like residential where the tenant can just bail on the lease and you've got no real means to chase it, because residential is getting more and more tenant friendly. That's just the reality of the world, and it's happening in every country. And commercial, it's not tenant friendly. It's like, it's a legal agreement.
Yeah.
And if anything, it's landlord friendly.
Yeah. Cool. Last question for you on the differences. The admin of commercial versus residential. So maybe 2 months ago, your boy went on a 25-minute rant about my one of my resi properties, where the property manager had not kept the tenant responsible, or the lawn had overgrown. We'll find some pictures. Em can chuck the pictures in. Mike and I had, how many weekends in a row did we spend at this
2 or
property?
3.
Yeah, doing like retaining walls,
rebuilding
and
retaining walls, and
pulling stuff out.
Yeah.
I hear commercial from an admin. I mean, you're still going to have issues and things pop up, but in general, easier to manage the tenants than
You don't reckon
than
we'd
resi?
have to go rebuild a commercial retaining wall out the back of a
Oh,
factory,
I tell you
mate?
what, Mike loves, Scott, if you ever need some help, Mike loves a bit of admin. He'll pop over to Sydney, help you put a retaining wall in the backyard.
He's handy, is he?
Yeah. Well, he
Perfect.
says he's handy.
Yeah.
Mike and I maybe 7-8 years ago built a deck in my backyard, didn't use galvanized nails, and they rusted through in about 2 weeks.
I still maintain I picked up the right box of nails that now filled with nuggets.
Yeah, they rusted themselves through.
Yeah.
So anyway, coming back to the question, admin on the property, commercial versus resi.
Yep.
What are your thoughts?
Look, it is lower, 100%. Because again, think about your tenants as a commercial landlord. You're going to be dealing with listed companies, with corporate backgrounds, or most of the tenants we've got. My wife and I, 65 commercial tenants, and most of them, an accounts payable department is who pays the rent. Sometimes it's from a head office from a far, far away land, and they don't even know what they're paying. They're just paying it. And then sometimes you are dealing with sole traders, and they can be a little bit more like the residential style. But even a sole trader, like if you've got a shop, that's their livelihood, they've got more risk in it than you do. If you lose your tenant, yeah, it's going to suck. But if they leave, then
they have
no
nowhere
job
to trade from.
and they've probably got a lot of money invested. They've probably got staff. They're responsible. Like rent is a very important part of the business. And again, like look at your office. If you're paying rent here, you are going to keep this immaculate. So you're not going to let it go to crap because it looks bad for your business. And, you know, if you have clients come in here. So residential, you know, again, like they might just, you know, I've had properties where, you know, it's been flooding through the roof and they just didn't even bother calling us. And then you get there 3 months later and go, oh yeah, it's been leaking. Like you just would never get that with this because it would leak on your computers and, you know, you'd be really angry and you'd go, I need it fixed. Like
I need it fixed now.
So I love the corporate side of it. It's more scalable. You've got companies that have seriously good reputations. And even the ones that you've never heard of, you know, it's their livelihood. But yeah, look, the admin it's a lot more scalable. Like, you know, I've got one of my tenants pays $500,000 a year in rent. You know, that's like, imagine trying to get $500,000 in rent from an entire portfolio of residential. So larger tenants, just by the scale of them, can actually wipe out the, you know, equivalent of 50 other houses with one tenant. So that's what fund managers do. They have the giant $1 million plus leases, and like you can collect a lot of rent for very little effort if you can get to that scale.
I like we were at dinner last night and you were like, one of them's a supermarket and you're like, if they didn't pay rent, I wouldn't even know how to contact the person to be like, where's my rent?
Go to the checkout and they're like, hey mate.
Exactly. Like, because one of our tenants is Audi. Like they'll always pay, you know, especially the methodical German nature of them. But like if they didn't pay, like I wouldn't know who to call. Call up their 1-800 number. Or, you know,
I love the idea of popping into the checkout. And we'll take a camera with us, and you go, mate, behind the till. You just
empty that out, would you?
$5,000 for the week. Okay, let's pay up. 16-year-old behind the counter is just like, oh, awesome. Okay, all right. Well, Scott, thank you for sharing all of that. If listeners want to kind of reach out, find out more about commercial property, how do they get in touch?
If you're in NZ, just Rethink Investing NZ. If you're in Australia, just Rethink Investing or Rethink Group. So, love to have a chat and chat about your situation on property.
Cool.
Awesome. Okay. And then just make sure to subscribe to the channel because we are going to do some more episodes with Scott. Much love to Partners Life who are sponsoring this episode. Please make sure to give us a review. Hit that subscribe button again, a like, and we'll catch you next time.
Cheers.